Strong consumption means developing Asia is on track to grow faster this year, even though global demand is weak. That is the latest assessment from the Asian Development Bank. The Manila-based lender has updated its economic outlook for 46 countries of the region from April, and it's keeping its 2023 growth forecast at 4.8%. It has revised its forecast for next year down to 4.7% because of risks such as Russia's war on Ukraine. And the ADB says inflation is heading back towards pre-COVID levels. The bank has cut its inflation forecast to 3.6% this year. Let's take a closer look at the report with the Asian Development Bank's chief economist, Albert Park. Albert, welcome back to DW. So ADB has cut its inflation forecast to 3.6% this year. What does that mean for the people living in the 46 economies you're keeping an eye on?
Well, relative to earlier this year, we're now forecasting energy prices to come down a bit. So our forecast is for oil prices to be $80 this year, $84 next year, which is lower than before. And so with lower energy prices, also falling food prices, we think it'll provide lower inflation than we had previously predicted, and levels that are starting to get back to pre-pandemic levels. So unlike many other parts of the world, inflation is much more modest here. China in particular is reaching very low levels, has been very steady at showing very low levels of inflation.
There's even the risk of deflation there in China. Some are saying there will be more monetary tightening, though, in the United States, albeit moderate tightening, and the European Central Bank wants to keep raising interest rates as well. What will be the knock-on effects for developing Asia?
Well, obviously, higher interest rates in the U.S. or Europe put financial pressure on the region. It leads to money or funds flowing away from Asia and back to the West. It creates pressure for depreciation of currencies. So because there's so much uncertainty about how much tightening is really needed in the U.S. and in Europe, I think we'll just have to take a wait and see. We're certainly priced in some continued increases, but if core inflation remains stubbornly high in the U.S. and Europe, and the Fed and the European Central Bank continue to be aggressive in raising hikes more than expected, then that will certainly create financial pressures in the region in Asia, which will not be good for growth, because eventually it may lead central banks in the region to want to raise their interest rates in response, which will kind of cut off investment and growth. Right now, we already see monetary policy in Asian economies moderating, much fewer rate hikes, even a couple of countries starting to cut interest rates to continue and support the recovery from the pandemic.
Now, you expect China to reach its growth target of 5% GDP growth this year. What makes you so optimistic, given the latest rather lukewarm economic data coming from Beijing?
Well, actually, in our April forecast, we said 5%. In our update that was released today, we're sticking to 5%. 5% is actually lower than most other organizations were forecasting 3 months ago, and still even today. So I wouldn't say we're overly bullish. It's just that there are reasons to expect continued recovery from the pandemic in many Asian countries. After countries moved away from lockdowns, et cetera, we saw a pretty steady increase in demand and recovery, and that is still supporting growth in many countries in the region. It's the domestic demand story, robust demand, as well as robust investment that's driving the 4.8 forecast we have for the region. In China, the recovery is very sluggish. We see that. The numbers don't look great. There's still high unemployment. Import demand from China has been very disappointing, which would be, of course, a boon to other countries in the region if it meant that China would be a better export market. That's still not really developing. The property sector in China is also having some challenges. And so for all those reasons, the recovery is sluggish. But we still are optimistic that the government will provide some modest supports, and that eventually we're hoping the Chinese consumers and investors in terms of the businesses will start to regain confidence, and we'll start to see some of the recovery momentum.
Albert Park, Chief Economist at the Asian Development Bank. Albert, thank you. And staying with the Chinese property sector, financial markets are still trying to digest that real estate developer Evergrande disclosed a net loss of over $113 billion for 2021 and 2022 and nearly $340 billion in liabilities. The staggering losses highlight how Evergrande's massive debts remain a serious concern for the financial health of the Chinese property sector and the world's second largest economy overall. The real estate sector makes up about a quarter of the Chinese economy's growth, and Evergrande is one of China's largest builders of apartments. For more, let's cross over to DW correspondent Zhou Zhanghan in Taipei. So, losses of $113 billion over 2 years. How serious is the situation for Evergrande, the company that the Chinese government has tried so hard to keep alive?
Well, it is very serious. Evergrande's net loss is around the number of global average GDP, and it set a record for the highest loss ever recorded by a Hong Kong-listed company. Evergrande's cash and equivalent assets almost amounts to nothing in the face of such a huge hole. And Evergrande has been expanding too fast in recent years, so it's too big to fall. If Evergrande goes bankrupt, it will cause a domino effect, which will affect the credibility and financing of the whole real estate developers and paralyze the real estate market. Unlike Germany's 50% home ownership rate, China's home ownership rate is 87%. When the real estate market cools, private investment will definitely follow. So it will have a huge impact on Chinese economy.
China's property sector is incredibly important to the country's economy. What do Evergrande's problems tell us about the state of the sector overall?
Well, before COVID, the real estate market was an important driver of China's economic success. So in the past 2 years, the officials launched a series of policies to guarantee the delivery of buildings, hoping to reduce the impact on the housing market. But multiple damage has now emerged. Not just the construction industry and services related to home building and sales. As I've mentioned, homeowners also cut back on spending for fear of losing their most valuable asset, which in turn impact private consumption. More to that, many enterprises in China use real estate as collateral for their loans. Overall, the shadow of the real estate market is likely to continue to loom over China's economy for not just now or to the end of this year, but for a long, long time.
Now, staying with the bigger picture here, so Evergrande's struggle prompted fears about possible shockwaves for the global financial system. The Chinese central bank says, well, its problems can be controlled and it's unlikely that they spill over. How reliable is that sort of estimate?
Well, Chris, we can totally expect that comment from the Chinese central bank. But the impact on the global financial market and economy is unpredictable because Evergrande's loans involve many international financial institutions, such as HSBC and Credit Suisse, etc. So its bankruptcy may trigger financial risks and crises that China cannot control. So Evergrande is now looking to reconstruct its offshore debt and provide more help to its creditors. If it works, it could allow Evergrande to act quickly to avoid a potential crisis due to offshore lawsuits over defaults. And we can observe that if Beijing will increase stimulus measures like cutting interest rates and increasing support to local governments. Other than that, we'll have to wait and see.